Nice. So now we're going to have Carlos Esquivel from Rutgers talking about underinvestment and misallocation under sovereign risk.
Okay. Well, thank you so much for inviting me, including in the program. We're going to shift gears a little bit. So the previous presentation was, we saw a lot of data. Here, we're not going to see much or any data. I'm going to try to make a couple of theoretical points, right? And this paper falls under the realm of sovereign default risk, right? So it is a macroeconomics paper, usually talking about open economies that borrow from abroad. This used to be a very niche literature, used to mostly talk about Argentina defaulting on its debt. But then, since the European debt crisis, it got a lot more attention because we saw that other countries can run into similar issues, right? So what I'm going to be talking about is the relationship between aggregate investment and default risk, right? And there's a very basic observation that so default risk affects expected returns to investment, right? It can be through higher expected taxes if the government is in default, right? The government has a certain amount of expenditure that it needs to finance, and if it loses access to financial markets, it's going to have to tax more. And there's also a feedback effect from capital allocations themselves, right? So capital allocations, both the sectoral allocation and the aggregate level of investment, affect future potential output, which is the government source of tax revenue. So if that is changing, then default incentives are responding to investment decisions. So, I mean, this is not new, right? So there's a big existing literature on debt overhang that has focused mostly on how highly indebted governments and how this debt burden affects investment, right? And the typical point here is that government indebtedness slows down investment and depresses growth. Then, more specifically on the sovereign default literature, there's been two big points made, right? One is that aggregate investment in general improves the government's ability to borrow, right? So an economy that is investing a lot is less likely to default in the near future, and that allows the government to borrow at more convenient terms. Another more recent point is that sectoral investment matters, right? And in particular, in the European debt crisis, what we observed in the data is that investment in non-traded sectors like services, for example, was more deeply affected than investment in other more tradable sectors. Now, and this is where the contribution of this paper is going to come in. Most of this literature, usually for simplicity, looks at environments in which a sovereign is able to pin down all allocations in the economy, including investment, right? And that's useful, right? Because you can disentangle how these two effects interact with default incentives. But what I want to do is to look at a slightly more realistic environment in which the private sector is making these capital allocations. And the key difference is that unlike the existing literature in which the allocations are constraint efficient, here the allocations are no longer constraint efficient. And the basic point from which this is coming from is the fact that the private sector is not going to internalize how capital allocations affect the government's ability to borrow, right? So there's got to be a situation in which if the government could coordinate better with the private sector about how much to invest and in which sectors to put it, everybody could potentially be better off. Okay? So in order to do that, I'm going to disentangle and talk about two separate externalities that are coming from capital allocation. And I'm going to show you two very simple toy models of two periods that flesh out the intuition very nicely. So the first one is going to be about the aggregate capital stock, right? So this is going to be a model in which I'm going to make the point that capital reduces default incentives, and this is going to happen under very general assumptions that are usually embedded in most of these macro models. And the result from this is that the economy is going to feature underinvestment under the decentralized equilibrium. Okay, and this is going to call for some policy. In particular, it's going to call for investment subsidies, in particular during periods of distress. Right, so I'll get back to that detail later. The second toy model is going to be about the sectoral allocation of capital. Right, so here I'm going to try to shift the focus to the portfolio of investment, in particular thinking about tradable and non-tradable sectors. Right, and why is that distinction interesting? Because usually the debt that the government defaults on is debt held by foreigners, typically denominated in foreign currency. Right, so here we're not talking about a country like the US, we're talking about more like an emerging economy like Argentina, in which they issue debt in dollars and you need some source of tradable income in order to service it. Okay, so here what is going to happen is that having more tradable goods is beneficial for the government in terms of it facilitates the payment of like future debt payments. So this economy is going to feature overinvestment in non-traded sectors, right? The private sector is not going to internalize like this feature of the debt, and this is going to call for subsidies that distort the portfolio allocation of capital. Okay, and then in the end, I'm going to expand these two models into a full-blown quantitative macro model. And I'm going to use it to talk about the European debt crisis, right? So there I'm going to discipline the model with some data in order to mimic Spain. I'm going to simulate the debt crisis in Spain in 2011. And I'm going to show you how the model, in the model, these externalities are amplified during the crisis. And that the recovery is much slower in the decentralized equilibrium, precisely because of these externalities. Okay, so that's what we're going to do. So I think right now it's a good moment to ask if there are any big picture questions. As I said before, all the details are coming. Okay. Great. So also in the interest of time and because this is not a sovereign default crowd, I'm going to maybe skip through the literature review, not to bore you with that. And let's jump into the two-period models. Okay, so this is the environment that both models are going to share, right? So I'm going to look at a small open economy. It's going to be a continuum of identical households, a competitive firm that produces a good, and a benevolent government, right? So here I'm going to abstract from any political economy frictions that are usually like present in this literature and are very interesting. And I'm doing this on purpose because I want to focus only on the investment externalities, right? So I want you to walk out of here looking at that there may even be some room for like additional policy intervention, even if you have a government that behaves quote unquote nicely, right? So there's not going to be any preference disagreement between the government and the households. The only difference is that the government is going to be limited in the tax instruments that it has access to. There's going to be international lenders that are going to lend to the government that are going to be risk neutral, have deep pockets, and buy the government debt, right? So these are very boring agents that are not going to be considered in the government's objective. And their sole purpose is to price the government debt. Okay, now that environment is shared by both models, and the key difference in each model is going to be coming from the production technology. Right, so to talk about what I call the capital stock externality, I'm going to assume that there is a single tradable good, that is that consumption good that the household eats. And I'm going to focus on the investment decision. For the portfolio externality, I'm going to have a slightly more complicated production technology that is going to include intermediate traded and non-traded goods. I'm going to fix the stock of capital so that way we can focus solely on the portfolio decision. Okay.
And what is the source of uncertainty?
Yes. Okay. So there's going to be a productivity shock. That's going to be the only source of uncertainty, right? So it's nice that you asked, and it's going to look like this, right? So in the first model, right, there's a unique tradable good, Y, that's produced with a production function that is going to use capital, and it's going to be affected by this productivity shock, Z. right? So those assumptions are important for the proofs that are like, for the theorems that I'll show you later. But they are all like fairly standard, right? So production is strictly increasing in capital and concave, and there's complementarity between productivity and the capital side. Okay, so the source of uncertainty. There's going to be productivity normalized to 1 in the first period, right? So the first period, there's no uncertainty and there's nothing interesting happening before the agents move. And the productivity shock in the following period is going to be, it's gonna follow some generic distribution G with and leaving a bounded set. Okay, so households are identical, and there's a measure 1 of them. So each household is endowed with the exact same amount of capital in period 0. That's given. And they're going to choose how much capital to install for production period 1. Households rent this capital to the firm at a rate R and collect firm profits. And the firm is competitive, so this rental rate of capital is just going to be equal to the marginal product. Okay, so all of that is standard. Then on the government side, an important assumption is that households do not have access to financial markets, right? So the role of the benevolent government here is to borrow on behalf of the households. The government is going to have some legacy debt. You can think of this as debt inherited from some other government in the past. And it's going to be issued debt B1 that is due in the second period. So here the aggregate state, right, which is going to be the relevant state for the government, is going to be the productivity shock and that vector of the aggregate stock of capital and the amount of debt. So the interesting decision in this economy is the default decision, right? So default is going to happen at the beginning of period 1. The government is going to observe the state, in particular the realization of the productivity shock, and optimally choose to default if it is more beneficial, right? So since it's the end of time, it's just a 2-period model, the government is going to choose to default if that yields higher consumption, right? So the trade-off between defaulting or not is going to come from a productivity penalty, right? So here I'm going to assume that if the government chooses to default, productivity is going to be lower, but the government gets to not pay that B. Okay. So this assumption of the productivity penalty can be microfounded in several ways. So you can think of the private sector losing some access to financial, like international markets as well, either through trade embargoes or embargoes to access to working capital. That would yield like more inefficient allocations in the production side that could like lower aggregate TFP. But for now, I mean here I don't want to focus on that. So it's just going to be like an assumption that is going to allow the government to borrow ex ante and to optimally default ex post. So given this environment, we can characterize the default set, right, as the set of productivity shocks for which the government would default, given an aggregate state X. Right, and this cutoff is going to be a cutoff that's going to be such that the government is indifferent between default and repayment. Okay, so the timing within each period is going to be as follows, right? I'm going to assume in period 0 that the government moves first. So the government is going to decide how much debt to issue, and the government is going to take into account how this decision is going to affect the households' choices. Then households will observe the government's choice and make their investment decision. And then in the end, foreign lenders are going to observe the aggregate decisions and price the debt according to this formula, right? So this is just saying that that's the actuarially fair price for debt. Lenders discount the future at some fixed interest, international interest rate R star. And they're considering the probability of default, right? So if you remember, that C star is the cutoff value under which any lower productivity than that, the government would default. The probability of that not happening is 1 minus the CDF of C star. And then in the second period, less interesting things happen, right? So the government observes the realization of the shock and decides to default or repay. And then, given that decision, production and consumption are pinned down. Okay. Any questions on this? Okay, so now in the next slide, I'm going to show you some Euler equations that come from the household's problem. And I think they're going to be very standard, right? So if somebody is curious and want me to show you either the government's or the household's problem, I can do that. But if not, let me just move on. And if questions arise, then we can come back to this. Okay. Also, the definition of equilibrium. Okay, so this I think I should show you. Okay, so an equilibrium in this economy, right? It's a policy function for the households, a quantity of debt issued by the government, and a price schedule, and some beliefs for the household that satisfy these conditions, right? So the government has to behave optimally by choosing B star, taking as given the price schedule and the household's policy function, right? So that's taking that K star as given is how the government understands that issuing debt is going to affect investment. Households have some beliefs, right? And given those, so households have some beliefs about how the aggregate stock of capital is going to move, meaning how the other households are going to make their investment decision. And given that, that K star has to solve the household's problem for each B that the government could choose. I'm gonna, this condition is important, right? It says that beliefs are consistent, right? So that's a rational expectations assumption that households understand that other households are behaving optimally. And that's how they operate. And finally, the price of the debt is actuarially fair. Okay, I'm going to refer to equilibrium allocations, right, with these theories.
So the households don't buy assets, and this is because you have a benevolent government, or
yes, and because I don't let them, right? So I assume that the only way households have to smooth is through the accumulation of capital. They don't have access to international markets. I could assume that households can insure each other, but then since they're all identical, they would not be. I mean, it would be a domestic asset that would not be traded. Yeah. Okay, so what are households going to do? They're going to do what households typically do in the classical growth model. They're going to choose investment so that the marginal cost of investment, which is the marginal utility of a foregone unit of consumption in the present period, equals the expected marginal return, which is the expected rental rate of capital. Right? So that expectation is taking into account the probability that the government defaults in the next period and the productivity penalty that would accrue with that decision. Okay, so there's nothing new or surprising about this. What is interesting is when we think about what would the government do if the government could choose the capital allocation directly. Right? So then the government would also try to maximize households' utility, and it would do something almost exactly the same, except for the fact that the government would consider how the capital allocation is going to affect the price of its debt today. Right? So the idea here is that the government would understand that the aggregate capital stock in the next period is going to change its own default incentives, and it's going to change how much resources it can collect in the present from international lenders. Right? So this decision potentially expands the ability of the government and households to consume in the first period. Okay, so now the big immediate question is what is the sign of that derivative? Right? So is the price of debt increasing or decreasing on capital? And this is the first important result in the paper, is that the default set is shrinking in K. Right? So what does this say? Intuitively, it says that the more capital the government installs for the next period, the lower the probability of default, and thus the more resources the government can collect. Okay? So given that result, right, if you try to impose the efficient allocation to the households Euler equation, the households are going to see that they're investing too much, right? So the marginal utility of investing a little bit less in the present would be much higher than the expected return. And that's because households are ignoring that additional red term over there. Okay, so this is the result that is going to yield that there's going to be underinvestment, right, in the decentralized equilibrium. Okay. Any questions? Okay, so now I'm going to move on to the second toy model, that this is going to be about the portfolio allocation. And methodologically, it's going to be the same thing. Okay, so now, as I anticipated before, the only difference in the environment in this second model is the production technology. So now this final consumption good is going to be a CES aggregate of intermediate traded and non-traded goods. Each of these intermediate goods are produced with capital, and they are subject to the same productivity shock. Okay? So another thing that's going to make this model interesting is that I'm going to fix the amount of capital in the economy and just assume that it doesn't depreciate. Right? So there's just some stock of coconuts that are there, and the household has to choose in which parcel they're going to put them. Right? So each household is endowed with the exact same amount of capital, and the interesting decision is in which sector to invest. Okay, so I'm going to introduce this notation that is just going to be the share of capital that is allocated into the traded sector, right? And 1 minus lambda is going to be the share in the non-tradable sector. Okay, and I'm still going to continue to differentiate between the portfolio that an individual household chooses and the aggregate portfolio in the economy. Right? And as it was the case before, since all households are identical, in equilibrium these two are going to be the same. But this is the one that is going to matter for aggregate lenders and for the government incentives, while this one is not going to directly affect any prices because households are atomistic. Okay, as before, the government has some legacy debt. It's going to try to smooth out consumption by issuing some debt that is due in period 1. And the default decision is going to be happening in the same fashion. The only difference here is that now the default action only liberates resources on the tradable sector, right? So when the government chooses to default, it's going to be able to consume more tradable goods since it doesn't have to service the debt. But because of the productivity shock, that is unambiguously going to decrease the amount of non-tradable consumption. Right? So if you think of this there's some balanced basket that households may want to have, the default action is going to unbalance it a lot. And this also allows me to define the default set in the exact same fashion. There is just a cutoff productivity level under which the government will choose to default. And the timing is the exact same as in Model 1, right? So the government first chooses how much debt to issue, households observe this and make their portfolio decision, and then lenders price the debt in an actuarially fair fashion. So what is an Euler equation in this economy? Well, in this economy, the Euler equation for this lambda portfolio is going to look like a no arbitrage condition. Right, so if you think of what competitive households do in a free market economy, they're going to choose their portfolio so that the expected return in each sector is the same. The government, right, if the government could be a benevolent planner, it would do something almost exactly the same, but there's again going to be this extra term that the government is going to consider how the portfolio allocation is going to change its ability to borrow. Right? And this is the second important result, that under the same standard assumptions, and in addition, as long as traded and non-traded goods are quote-unquote complementary enough, right, so that this elasticity of substitution is lower than 1, then the default set is shrinking in lambda. Right? And this is the intuitive direction in which you would think that, well, in order to service the foreign debt, you need tradable goods. The higher share of capital that you allocate into the tradable sector is going to make it easier to service the debt, and that's going to lower the probability of default. Right, and then we have a similar corollary, right? So the price of the debt is increasing in lambda. So then this term over here is positive. So again, if we make the same exercise and we impose to the households the efficient allocation, the households are going to perceive that they're leaving some money on the table in the non-traded sector, right? So the expected excess return in non-tradable goods relative to tradable goods is going to be positive in this economy under the efficient allocation. Okay. So now, okay, I'm gonna build a full-blown quantitative macro model that's gonna feature both externalities at the same time in an infinite horizon economy, and then I'm gonna use it to do some numerical exercises and talk about the European debt crisis. Okay, so what is going to be different now? Well, there's going to be two stocks of capital that are going to be moving around each period. Each is going to depreciate at a rate delta, and I'm going to assume some adjustment costs, right? That are going to help me discipline the dynamics of investment in the quantitative exercise. So the final good is going to be used only for consumption and investment, and that's going to be the aggregate resource constraint in the economy. I'm going to assume now that productivity follows an AR1 process, right? It's persistent and standard, and I'm going to allow the government to issue long-term debt, right? So how is this going to work? Well, I'm going to assume that there is some stock of debt that a fraction gamma matures each period, and the fraction that 1 minus gamma that did not mature has to pay a coupon gamma. Okay, so this is a geometrically declining stock of debt. But then each period the government gets to issue a little bit more. Okay, the aggregate state now, right? I'm going to use the same notation. It's going to be the productivity shock and this vector x that includes both stocks of capital and the stock of debt. And within each period, I'm going to assume the same time, right? So the government will observe the realization of the shock, make its default decision, and also make its borrowing decision. And then after that, households will observe it and make investment decisions. Right? And in the end of the period, the debt auction is going to happen, given the previous decisions, and then we move on to the next period. Right? So this is almost like the same two-period models, just repeated infinitely.
So is it the budget constraint or a feasibility constraint?
So that's the resource constraint for the final good.
Why do you have prices?
Because there's adjustment cost of capital, so the price of capital is not one.
But then we have consumption investment adjustment costs, and that has to add up to Y, no?
Right. So yes. So no, actually, so it would be no. You're right. So this is the budget. This is like an aggregate budget constraint, right? So the resource constraint would be consumption plus investment plus the adjustment cost, and that has to add up to Y. Yeah. Thanks. So how do the Euler equations look like here, right? So in this economy, there's each stock of capital has its own Euler equation, and both Euler equations imply a no arbitrage condition that looks like that, right? So that's reminiscent to the second two-period model. And if we look at what a benevolent planner would do, the benevolent planner will still have these additional terms, right? So now, what the planner does is a little bit more subtle, right? Because there's two stocks of capital, so it's going to depend on how each stock of capital affects the government's ability to borrow. These two are in general going to be different, and in fact, right, in the numerical examples, this one happens to be bigger than that, right? So both are positive, right? And I'll show you in a minute. But the idea again is that So having more capital in general makes it more painful to default because you're foregoing more returns. But capital in the traded sector is particularly more beneficial to service the debt because that is the actual resource that you use to pay for it. Okay, so given that this difference is in general positive, we're going to have that when the government wants to borrow, right, which is typically in periods of crisis, right, so the government tries to borrow in order to smooth out the crisis and expect to get out without having to default. So in periods of crisis when BT plus 1 minus the current stock of debt is positive, then this whole term is going to be positive. And then the economy is going to feature both aggregate underinvestment on both stocks of capital and overinvestment in the non-traded sector. Right? So what I did here, right, was to simulate. So I have two parallel economies. I have the decentralized economy and I have an economy with a central planner. And I simulate a lot of periods and compare long-run averages. Right? So on average, the aggregate stock of capital is larger in the planner economy, both in absolute terms and as a fraction of GDP. And the portfolio that the planner chooses is more tilted toward traded goods. Right? So the planner invests more, a bigger share of capital in the traded sector. And the planner is able to borrow more in absolute terms. Right? And the planner is able to borrow more because it can do so at more convenient prices because of these two choices.
Question over here.
Yeah, sorry.
No,
Yes.
just very quick. So, are the traded and non-traded sectors, is it trade within the economy or with other economies?
Good. So the non-traded sector is just within the economy. The traded sector can be either bought by households to consume or just pay it out to foreigners to service the debt.
So, that initial assumption that households didn't engage in international, or maybe I'm getting confused, but wasn't there an assumption in the beginning that households?
So that households don't engage in international trade of financial assets. So they cannot issue or they cannot borrow from the rest of the world.
Okay.
They can trade the good.
Okay.
Yeah. Any other question? Okay. So I mean here numerically we can I can illustrate the effect that the portfolio decision has on the government's ability to borrow. Right? So what I'm doing here is I'm taking the price of debt that depends on both stocks of capital. I'm numerically choosing some aggregate stock of capital and keeping it fixed. And I'm just changing the share allocated in the traded sector. Right? And that's what I'm plotting right in the horizontal axis. The vertical axis is just the spreads, right, of what. So that price of the debt has an implicit yield for the government debt, and I can compute the spread of that yield versus the risk-free rate, and that's this spread over here. Right? And I'm doing it like this so that you can put some meaning to these numbers, right? So let's say if U.S. Treasuries pay 5%, this one means that Spanish bonds are going to pay 5%. Yeah, I mean 6% instead of 5%. Okay. So what you see here is that the lower the share of capital in the traded sector, right? So the more tilted toward non-traded goods the economy becomes, the bigger the spread, right? So the government, the servicing the debt becomes more and more expensive. Also, each line is for a given particular stock of government debt. The more indebted the government is, obviously, the bigger the spread because it's more likely that the government defaults on a bigger amount of debt. But the slope of this becomes steeper, right? So the externality becomes worse the more indebted the government is. Right? And this, I mean, all of this is not obvious, right? So in this richer environment, it's hard to have theoretical proofs. But numerically, it appears to be that the intuition from the two-period models follows here. Okay, good. So what happens with a negative shock, right? So now these are impulse response functions. And what I'm doing is that I am looking at an economy in the ergodic state, right? So that has like average stock of capital and debt. And then I shock it with a negative productivity shock, right? So that magnitude is like -1 standard deviation in productivity. And I am comparing the planar economy and the decentralized economy. So what we see is that spreads go up, right? Low negative productivity shock, the economy is in trouble, and the probability of default increases. But spreads go up a lot more in the decentralized equilibrium. And the reason of that is because investment is depressed a lot more. And this is because households are using lower investment in order to smooth consumption, because they cannot coordinate with the government to smooth with issuing debt instead of lowering investment. So investment is depressed a lot more, which in turn makes GDP a lot more depressed. Now, the big trade-off, right, in terms of utility and consumption comes from here. You can see it here. So the planner would choose to lower consumption a lot more on impact in order to not lower investment so much. And then recovery would be much faster, right, than in the decentralized economy. And also you can see it in the current account reversal, right? So there is a big reversal in the current account because access to borrowing is almost like shut down. But the reversal is almost like 3 times as big in the decentralized economy, right? So that looks like a big sudden stop of capital inflows, whereas the central planner would have like a similar reversal in the same direction, but much smaller.
Carlos.
Yeah.
Can I ask? So why wouldn't investment overshoot at some point in time, like be positive? Because usually like they drop, but then if when the model when the economy reverts back to the steady state, then
right,
the investment has to be like above.
It would overshoot. Yeah. So I mean so this percentage change relative to the initial steady state. I mean, in these like 40 quarters, the shock has not reversed. Right, so I think that may have to do with the shock. Right, it's still depressed. Like if I like show it back like faster. Right, so here I'm letting the shock just follow the calibrated layer 1 process. If I made it like a one time and then go back, then we would see something like that.
And also like a stupid question: why wouldn't your productivity shock be like smooth? Because that's an exogenous process, right? It should be like
yeah. Oh, okay. So one more thing. So each line is the average path, right? So each line is the average of 10,000 paths. Right. I mean, if I only do one path, the productivity shock would be like very, very noisy. If instead of 10,000 I do 100,000, then that would become like super smooth. Because so there's other shocks on the path, right? It's not just the one-time shock and then like return with the persistent parameter. I'm letting the other shocks happen. Okay, so if we sorry.
Yeah. So if what I'm getting at from looking at the graph there is that after a shock, the economies tend to recover over time to the planet, right?
Yeah.
So would governments then be incentivized to like if they had a foreign investor buy their debt, would they then be incentivized to have another investor buy that same debt to pay back the original investor to remove the risk of defaulting and to like have?
Yes. No. And great question. So that is going on all the time, right? So I am assuming that there's a big number of investors out there. The thing is that all investors are pricing the debt equally, right? So I can if I owe you, I can either tell you, okay, roll it over, right? Like a credit card. Just like, let me borrow from you again to pay you back, or I can borrow from him to pay you back. The thing is that both of you are going to offer me the same price. So from the point of view of the government, it doesn't matter. So richer dynamics could emerge if investors are different, right? So for example, if you're borrowing from banks, and then you go to the IMF, that may have a different objective, and may be willing to let you borrow at a more convenient price. Good question. So now we're zooming into the sectoral dynamics, right? So before I was showing you aggregate investment. here we see that investment in the non-tradable sector is more depressed in the decentralized economy. And the real exchange depreciates, but it depreciates a lot more also in the decentralized economy. And I think this is the key part, right? So this is some, like a reason of why we would like to see this model, right? So if I compute the best the subsidy rates that would implement the first best allocation, the efficient allocation, we would get that they're positive, right, for both types of capital. Meaning, I mean, and this is coming from the fact that the economy is underinvesting overall, but it's more positive for the traded sector, right, because it's more beneficial, and it overshoots a lot as a response to a negative shock. Okay, so, and again, this was the response to a like -1 standard deviation shock. So now I'm going to look at something quantitatively more realistic. I'm going to try to mimic the European debt crisis. So this is the data, right? So I'm looking at Italy, Spain, Portugal, and Europe. And I'm going to use that first graph on the top left to create the crisis in the model. Right, so I'm going to look at paths of economies in the model for which spreads increase by a lot and there is no default. Right, so in the European debt crisis, the only country that actually defaulted on its debt was Greece. Italy, Portugal, and Spain, they only had like a hard time for a while and then recovered. Okay, so in all of the economies, investment got depressed a lot, which drew down consumption and GDP, and there was a reversal in the current account, right? So the trade balance became very, very positive, right? That's the stop in capital inflows into the economy. Right? So these economies suddenly became unable to get more resources from abroad and had to start paying off some of their debt. So how does this look in the model? Yeah. Question. Okay. Right, so in the model, that's what I'm doing here. Right, so I'm trying to center the model economies at period 0 at which spreads peak, but there is no default in these observations. Right, so what happens? Well, spreads peak up more in the decentralized economy, and the decentralized economy faces a steeper like trade reversal. Right, and investment drops by a lot more. Right, so what this is showing us is that, right, so the red line is the one that is comparable to the data, right? Because in the data we have investment being made by the private sector. So what this is saying is that the depression in investment, right, and the GDP downturn could have been like much smaller had the government tried to like subsidize investment during the crisis. Okay, so this is what I want you to take away from the talk, right? So in general, there is the presence of default risk induces the economy to have underinvestment in the aggregate, and there is some like misallocation of capital within the sectors in the economy, right? And that is gonna like manifest as the economy is having like weaker real exchange rates than they would otherwise have. Okay. Importantly, these externalities are amplified during crisis because default risk goes up. Right. So the bigger the default risk, right? So remember that graph of spreads. The bigger the default risk, the steeper the slope becomes. So the more sensitive this price becomes to the capital decisions. Okay. So what are the policy implications for this? This calls for subsidies to investment during crisis, and in particular, bigger subsidies to tradable sectors. Right, and that could like these subsidies could potentially like help the economies navigate this debt crisis a little bit better. Okay, so that's all I have, and I'll have answered any questions that you want.
All right. Well, thank you, Carlos.
Yeah.